it is very important for companies to understand the market. And when it comes to understand the market, companies should first grasp the overall environment in which we're going to operate. And this is true wherever companies are working in the domestic market, but even more for companies that are addressing multiple markets, such as multinational companies or scale-up startups that are entering into new markets. For all these companies, it's really important that they understand what are the fundamental trends, the fundamental pillars of all the markets in which we're going to operate. And why is this so? There are many reasons behind it, but the easy, simple, brief answer is these factors, even though we can consider them as external factors to the company, to the business, to the product, can heavily impact on the success of a new product development, on the success of a market penetration, and so on. Another important point to keep in mind is external environment is one of the dimensions that can impact on our business. But from company perspective, what we need to know, what we need to do when we are analyzing the external environment is to identify in a very sharp way, prioritizing the key drivers of change. So here, we are not just describing, we are not just, to an extent, passively observing the environment, but proactively, we try to identify what is the bottom line for our business. What is the implication? What are the conclusions that we can draw from external environment factors? Without further ado, so let's now dive deeper into today's class. In this class, we are going to see first the different layers of business environment. Then I will show you the difference between the external market analysis and the industry analysis, because these are two different things which we need to clarify. And then in view of creating possible future scenarios for our business analysis, we will see one key paradigm which we can use for the environmental analysis. This paradigm is called Pestel analysis. Okay, so what we can see here are the different layers of a business environment. So at the core, there is our organization, our company. And then on the external layers, we have a macro environment. The macro environment is the focus of this video lecture. Then the industry or sector, sometimes you will also hear vertical. So this is essentially the specific marketplace in which you are competing. So in each industry, there will be similar companies doing a similar type of products or delivering similar type of services and competing against one another. Put it like this, sounds simple. Actually, under each industry, there are sub-industries. So it's so much more granular than this, but just to give you an initial idea. So an industry could be banking. Banking is an example of an industry. Another industry could be retail. Then under retail, we do have so many more differentiation. In the industry, we lead to the layer of a competition. So how we compete against other companies that are in our same vertical, in our same space. All of this, the macro environment, industry, competitors, the market, so all of this are part of this bigger idea, bigger umbrella, which we call external environment. The framework which we're going to study today, the Pestel analysis, helps us to analyze the macro environment. And I would like to differentiate with the industry analysis. the industry analysis is a way to evaluate, is a way to assess how attractive an industry is. So industry analysis is not about our company in the industry, but the industry analysis is about how attractive, how appealing the industry is. And essentially, it answers the question, should we enter the industry if we are not in the industry, or if we are in that industry, should we stay in this industry? Should we hold our position in the industry? A very famous framework is used to analyze the attractiveness of an industry, which is Porter's 5 forces framework. Michael Porter is to an extent the father of a modern concept, a modern approach to strategy. And among many of his theories, this became very mainstream, very popular. And through the 5 forces by Porter framework, we are able to evaluate whether an industry is appealing. And here you can see the different forces at play. So the force coming from the supplier, what is the power of a supplier? The force coming from the buyers, what is the power of the buyers? The threats of new entrant. Of course, if in an industry it's easy to enter, this means that so many new companies can enter into the industry, and that will make more difficult for us to hold the position and to exploit the profitability of the industry. And the other one is the threat of substitute products, and all of these lead to the level of competition, this concept of competitive rivalry within an industry. However, Michael Porter's theories are not the topic of this video. I'm just here giving you some heads up to differentiate what is the industry analysis and what is the macro environment analysis. One additional note on Porter's theory, they apply to not every industry. So we can use 5 forces on some industries, but not all of them. So even though it's a mainstream approach, use it carefully because it does not fit with the characteristic of every industry, and particularly does not really fit with the platform business model. So now let's step back to the main topic of the lecture, which is the macro environment and the Pestel analysis, which is the tool we use to analyze the macro environment. So the Pestel analysis, as we are going to see, is a framework which allows us to identify different dimensions: the political dimension, the economic dimension, the societal dimension, technology dimension, the ecological dimension, and the legal dimension. And this can be done from a double perspective. So from the market perspective, essentially means from our suppliers, from our competitors, from our customers, and so on. So primarily here we will be talking about economic interaction. But the Pestel analysis gives us also an additional perspective, which is a non-market perspective. So more of a social, political, legal, and ecological factors that to an extent are also intertwined, interconnected with the market factors. Consider, for instance, ecological issues. Sometimes ecological issues of a public debate on ecological issues will also lead to economic decisions. In why the Pestel analysis is important. So here I would like to clarify since the beginning, the Pestel analysis is not about describing a situation. It's not the role of a business to describe a situation. The role of a Pestel analysis is to identify these key drivers for change, is to create our strategy. So, of course, the first step is to understand these dimensions, to see what are the factors that are leading to possible change under each of these dimensions, and then to exploit, to act on these possible turning points. So usually the Pestel analysis will lead to forecast. So forecast essentially means to predict with some different degrees of precision or certainty what would happen in future. In generally, forecasts will focus on the mega trends, on inflection points, and on weak signals to understand when the economic situation is going to change. In the other consequence, the other impact of a Pestel would be the scenario analysis, which is a different kind of technique in which scenario technique creates plausible alternatives of possible futures. So that would be more of a storytelling on what could happen in the future based on trends which we see right now. Let's now move on into the analysis of the Pestel, in first of all into the dimension of politics. So politics plays an important role because here we can understand how free the economy is and what is the role of a state in the economy, and also what is the role of a civil society in the economy. So the role of a state should not be misunderstood. So of course, one clear meaning is the state being an economic actor, state owning companies. But it's not the only way the state can shape the economic landscape. So the state is also a customer, is also a supplier. The state heavily regulates many industries. So when we do our analysis, we really need to dig deeper into the role of a state. I think this helps you understand what I'm talking about. So here there are some examples of industries. For instance, the defense industry is a sector where there is a high involvement of a state. Many defense companies are generally owned by the state directly or as a minority shareholder. And of course, there is also high political exposure, meaning that, of course, if a state is promoting wars or peacekeeping activities and so on, and this is a way to feed the defense industry as well. And also, the main client of a defense industry is the state itself. So the state is generally the owner of this industry, but at the same time is also the customer of this industry. So this is an example of an industry that is heavily exposed to politics and with heavy involvement of government. Other industries could be more affected by political exposure. Food and beverage industry, for example. Food and beverage, there is quite a bit of political exposure, especially when it comes to alcohol. Alcohol is heavily regulated. There are excise taxes, there are limitations. For example, in some countries, which I'm not going to name, there is some limit in terms of time when you can drink alcohol or you can buy alcohol and so on, right? So this is an example of heavy political exposure of industry, but not so much of a direct state involvement, because the state is rarely an owner of food and beverage companies. Getting back to the prior slide, exposure to civil society organization. So this is also a dimension that we consider under the politics. This could be media, could be campaign groups, and so on, that can influence the way we do business and the key issues that businesses need to address. When it comes to the role of a state, in this political dimension, we should also consider two dichotomies. One is the macro-micro dimension. So the macro dimension is essentially political risk related to a country. So there are countries that change government very often with a lot of political instability. So this would be a macro dimension. It's a country where you can't really rely on the political stability of a country because things can change rapidly and suddenly. There is also the micro dimension. And the micro dimension is more specific to some organizations that could be targeted by the government or could be targeted by civil society. For example, from time to time, there are these quarrels among countries with also civil society being involved. So in the past, there were some issues, for example, between the US and France, and then US said, oh, we're not going to buy French cheese anymore. And American consumers said, okay, stop with French cheese and French wine maybe for a few days. So that was, an example of this micro dimension. The same happened also in China a few times between China and Korea, with Chinese consumer boycotting Korean products, or sometimes between China and Japan with Chinese consumer boycotting Japanese products. And the other point to consider is the internal external dimension. So sometimes the political risk is embedded in a state per se, so state with high political volatility. In some other cases, this risk can be from external factors. So it could be, for example, like a state moving a war to another state and then leading to political instability in a region, which happened in the Middle East 20 years ago or so, when the US first entered into Afghanistan and then to Iraq. And this increased the political instability of a region, which was already affected by political instability, but became even more political unstable and led to a lot of regime change in Libya, in Egypt, and so on. So we need to consider also these two dichotomy, the macro-micro dichotomy and the internal-external dichotomy. So moving to the second dimension, economics dimension. So here we have multiple economic factors that impact on our analysis, from the currency exchange to the inflation, the growth rates, and so on. And it's important to consider that generally in an economy, we can identify these three main economic cycles: the stock cycle, the investment cycle, and the infrastructure cycle. So our role will be to detect at which point of a cycle we are in and when the new cycle is going to step in. Again, I think this may help grasp better about this concept of the economic cycle. So we have a stock cycle. The stock cycle is generally driven by companies acquiring new stock, new raw materials for their operations. So generally, when we are in a period of economic crisis, companies will try not to have so much of an inventory, because if you have a big inventory, this is also a big cost for them. But when we see that the economy is growing again, then they will rush to purchase. So they're also like purchasing indexes that are analyzed daily, because this is a sign of the status of an economy. The second type of cycle is an investment cycle. The investment cycle is primarily linked with technology innovation, meaning that when we are entering into a new product life cycle, when we are promoting a new innovation, we need to invest in the capital, we need to invest in the equipment to create and produce this new innovation. In the final cycle is the infrastructure cycle. So this would be primarily linked to infrastructure project, and generally this is a cycle which is influenced by government. This is generally what happens in more emerging economies. They need to build up their infrastructure, and so the government will say, okay, let's promote spending in infrastructure. This happened multiple times in China in the last financial crisis. Well, maybe not really the last, because we just passed an economic crisis just now, but in the big financial crisis of 2007, 2008, the response by Chinese government back then was to initiate a new infrastructure cycle, which is about to end now, or probably even ended a year ago or so, when Chinese government became more aware that this type of development, this type of economic growth only based on infrastructure is not productive, is not efficient any longer. The third dimension of a Pestel is social dimension. So this is specifically related to society, and these also impact the demand and supply, and the innovativeness and productivity in organization. Related to this social dimension, there are some key concepts such as the demographics, so different age groups, such as the wealth distribution within a country, the geography, so the role of a cluster of innovation in an economy, or the role of a city in an economy. Think of Thailand, the role of Bangkok in the Thai economy, and as an example of an innovation cluster, think of the US in the Silicon Valley. Another important point to consider is that when we analyze the social dimension, we would like to identify also what are the relationship, what are the linkages between companies and organizations. And this will lead to the concept of network. And when we analyze a network, we identify these three key factors: the network density, the center hub positions, and the broker position. Again, let me show you here the organizational field, so a sociogram of social networks not as social media. So here we are talking about linkages among companies and organizations. So what we see here are some examples of the central hub position. So company A is in a central hub position with contribution from many other organizations. We also see that the network of company B is denser. What does denser mean? It means that there are more connections. As you can see, all the organizations in that network, they are exchanging information among themselves. They're not just exchanging information with company B, which means that everyone is on the same page. There is an exchange of creativity, of innovation, and the sharing of information in real time. Final concept is this brokerage concept. So as you can see, company A and company B are in a brokerage position, meaning that A is linking its own network with B's network, and the other way around. So B's network is linked via company B to A network. So these are the three concepts which we analyze in this slide: the central hub position, the density of a network, and the brokerage between two or more networks. This concept applies very well to startup and innovations. So innovation clusters do follow exactly this concept of the organizational field. So they will try to create high density of a network. There will be generally some organization in a central hub position. This organization could be venture capitalists, could be incubators, could be universities. And they will also try to do this brokerage. So the Singapore Innovation District being connected to the Hong Kong, being connected to the Silicon Valley, being connected to Israel ecosystem, and so on. This is also what the Thai ecosystem is doing. So increasing connection, following this idea of a brokerage with other innovation ecosystem in Asia Pacific, in Europe, and in the US. So moving on to the dimension of technology. So technology is the fourth dimension of a Pestel analysis. So this is essentially a way to assess the creativity and innovation in an economy. How can we do so? We can use these indicators. So we can focus on the research and development budgets of companies. We can look at the patenting activity. So how many patents being filed in an economy. The most important patent office globally is still the US Patent Office, but each country has a patent office. In Thailand, this is the DIP, the Department of Intellectual Property of Thailand. Another criterion is the citation analysis. So how many papers on science and technology being produced in the country. The fourth is announcement of new product development, and finally the coverage by media on research and technology activities. The second E in the Pestel analysis is the ecological. So in the Pestel analysis, ecological will relate primarily to environmental issues. Organization generally need to address three main challenges. First is a direct pollution obligation. So essentially to try to minimize the production of pollutants. So to implement a more lean production. This is especially true for manufacturing industries or industries that consume a lot of energy in their operations. Second one is product stewardship. So try to ensure that ecological issues are addressed along the entire value chain in the life cycle of a product. And the third one is the sustainable development. So essentially, sustainable development refers to avoid exploitation or over exploitation of some scarce resources, and also try to balance between the economic development and the stability and livelihood of local communities. Why this E is also important? For companies being in a context, and so in a context where ecological issues are now mainstream, so for companies, for businesses, it's important to be aware of this. It also depends on this concept of a network, of the organizational field. If you are in an organizational field where ecological issues are particularly strong, of course, this will lead to more awareness about it. And then the third dimension of a context is the internal organization, so the value of a company. However, there are also more business economic reasons to consider this E as well. So one is the competitiveness. Now consumers are actually happy to pay premium prices on green products. So why not do this? Why not do like some green products just to charge a higher price? Another reason is legitimacy. So there are strict regulation, especially in Western countries, about environment protection. So companies must comply with this regulation. And then the responsibility. So if there is any issues related to ecology and the company is somehow responsible, that would be very bad media coverage right now. So it's important to tackle this as a potential risk, otherwise can disrupt reputation of a company. The final dimension of a Pestel analysis is the legal requirement. that companies need to comply with. So we already mentioned about environmental rules, but there are many other set of rules that companies need to be aware of, from labor laws to consumer regulation to taxation, reporting requirement, governance of a companies, setting up of a company, ownership of a company, competition and antitrust rules, and so on. It's also important for companies to understand in what kind of economies they are working. So whether they are in a more liberal market economy. A liberal market economy means that essentially competition is encouraged, foreign investments are encouraged. There are no limitation on the ownership of companies, so foreigners can own companies without any limitation. Generally, entrepreneurs will raise funds through banks or investors. They will start up their companies, or they will take over existing companies. So this leads to a very aggressive market landscape. So this is the case of more liberal market economies, such as the United States. These are also economies where we see a shared ownership, in the sense that there is generally not just a family controlling a business, but there are multiple shareholders, including investors that are the actual owner of a business. If you look at all the big American corporates, they're not owned by a family, but the ownership is dispersed among a lot of investors, small retail investors, as well as professional investors. Other type of economies would be coordinated market economies. So these are still market economies, so following the principle of free markets. However, there might be some limitation on foreign investments in the economy, and also aggressive competition fueled by financial investment may be discouraged. And instead, these coordinated market economies will try to find a compromise among economic players. So this could be, for instance, the case of Germany or Japan. In the third case is development market economies. Development market economies are economies where there are more limitation on ownership of the companies, more limitation in terms of competition, more restrictions for foreigners to operate into some sectors of the economy. There will be also more role of a state to lead the economic growth. In some cases, the state is also the owner of banks, such as the case of China, the case of India, the case of Brazil. So this is the third category. So to sum up, we have liberal economies, coordinated market economies, and development market economies. China, Brazil, India, Thailand would be in this third category. Here you can find an example of using the Pestel analysis to evaluate a business such as H&M. And here is the conclusion on the Pestel analysis. Why we do the Pestel analysis? This is because we would like to identify these key drivers of change and make our prediction or construct our scenarios on what will happen in future. So to recap on today's class, what we learned is that for companies, it's very important to conduct a macro environment analysis, which is generally done through a Pestel analysis. This will help the company understand what are the factors from multiple angles, from multiple perspectives, impacting on the business. Keep in mind that the external analysis will impact on the business of a company, but the external analysis will also impact on the specific of the industry. An example of this could be through economic cycles, which we address during this video lecture. So economic cycle, especially during a downturn period, means that in some industry, there won't be much flexibility to respond to a bad economic period. So this is the case of discretionary consumer goods, such as restaurants, for instance. So if it's a bad economic period, so it will be easier for consumers to say, okay, I'm not just going to the restaurant for 1 or 2 years. In the same, we go for industries that have high fixed cost. This is the case of airlines or the case of hotels, especially luxury hotels. When there is an economic downturn, people won't go to luxury hotels, but still you cannot close down the hotel, you cannot reduce the service because a luxury hotel must have a good service. So it's going to be very painful for the company. So here, my conclusion point is that through the external, the macro environmental external analysis, we can also identify the factors that may heavily impact on our own industry. So we always need to keep in mind not only our own business, but also in which industry we are in. So if we are a luxury hotel and if we're doing the Pestel analysis, and if one of the key drivers coming out of a Pestel analysis is that we are going into an economic recession without government help for hotels and so on. So here we may be very concerned because our prediction or our scenario for the future will be quite grim. And on this note, I thank you for watching this video lecture, and I'll see you in class. Bye.